For much of the latter part of the 20th century, Japan was the envy of the world. Its economy boomed, fueled by an export-led growth model that saw its manufacturers dominate in sectors like automobiles and consumer electronics. But since the early 1990s, Japan has been stuck in a period of economic stagnation, often referred to as the lost decades. This script will examine the factors behind Japan's economic stagnation, and what the country can do to move forward. Demographic challenges. One of the primary factors behind Japan's economic stagnation is its rapidly aging population. The country has a declining birth rate and an increasing life expectancy, which has led to a shrinking workforce and a smaller tax base. This demographic shift has made it difficult for Japan to sustain the economic growth it experienced in the post-World War II era. To make matters worse, Japan has been slow to embrace immigration, which could help to alleviate some of the demographic challenges it faces. Without significant immigration, the country's population is projected to shrink from 126 million today to 88 million by 2065, which could further limit economic growth. Deflation. Another factor behind Japan's economic stagnation has been deflation, or a persistent decrease in prices. Deflation can discourage spending and investment, as consumers and businesses may delay purchases in the hope that prices will continue to fall. In Japan, deflation has been a persistent problem since the early 1990s, and it has been difficult to shake. The Bank of Japan has implemented a number of measures to combat deflation, including keeping interest rates low and increasing its monetary stimulus program. While these measures have helped to stabilize prices to some extent, they have not been enough to fully overcome deflation. Low interest rates. To combat deflation, the Bank of Japan has kept interest rates low for an extended period. While this has helped to encourage borrowing and spending, it has also had some negative consequences. For example, low interest rates can lead to a lack of investment opportunities, as investors may seek higher returns elsewhere. Low interest rates can also lead to lower returns on savings, which can discourage people from saving and make it more difficult for them to achieve their long-term financial goals. High public debt. Japan has one of the highest levels of public debt in the world, which has limited the government's ability to stimulate the economy through spending. With a debt-to-GDP ratio of over 200%, Japan's debt burden is much higher than other developed countries, such as the United States, which has a debt-to-GDP ratio of around 100%. The high level of public debt has also limited the government's ability to respond to economic crises. For example, during the global financial crisis of 2008 to 2009, Japan was unable to implement the same level of fiscal stimulus as other countries, as its debt burden was already very high. Corporate culture. The corporate culture in Japan has traditionally prioritized stability and longevity over innovation and risk-taking. While this approach has worked well in the past, it has made it difficult for Japanese companies to adapt to changing market conditions and take advantage of new opportunities. In recent years, there have been some efforts to change this culture, with Prime Minister Shinzo Abe implementing a number of reforms aimed at promoting entrepreneurship and innovation. However, it remains to be seen whether these reforms will be enough to fully overcome Japan's corporate culture of risk aversion. In conclusion, Japan's economic stagnation has been caused by a combination of factors, including demographic challenges, deflation, low interest rates, high public debt, and a corporate culture that prioritizes stability over innovation. To move forward, Japan will need to address these challenges. See you in another video. Thank you.